Hello everyone and welcome to this February 20th economic impact video, which will actually be my last one as I will soon be a new retiree from National Bank. But do not worry, the production of these videos will continue with our star, our chief economist, Stéfane Marion. Hello, Stéfane.
Hi, Martin.
So, Stéfane, we've talked about it, but we are now seeing it, a definite deceleration of inflation as we had expected. What do you think?
Well, some people actually notice that we see deceleration in inflation, Martin. We're at 6.4%, down from 9%, so clearly going in the right direction. We've been claiming this for many months. However, some people thought it would be decelerating faster at this point in the cycle, which has yet to be confirmed. But notwithstanding the fact that central banks continue to say that they might continue to hike interest rates, the bond market doesn't believe it anymore, Martin.
No, and we're watching this very, very carefully, this famous Fed fund versus 2 years. What's going on?
Well, the 2-year Treasury yield in the U.S. and same thing in Canada, Martin, is below the overnight rate or the policy rate of the central bank. So clearly what the market is saying right now, central banks have gone far enough. You might expect even a pivot in the coming months. And if we're lucky, perhaps a rate cut by the end of the year.
Mm-hmm. And what happens when we see this inversion?
It's market expectations. I never forget that the financial markets run on expectations. And when you see this inversion, which has happened last December 15 to be more precise, Martin, historically, the stock market does well during the period where you see the inversion of the curve until the first rate cut. And historically, there's a delay of 7 months. And over those 202 days, to be more precise, the stock market tends to deliver positive returns, around 8%, Martin.
So we did in about 60 days what we usually do in about 200 days.
Well, that's the thing. Let's not be too greedy at this point in time. What is quite peculiar in this rebound is that we've done it really, really quickly. So people are expecting the Fed to pivot really quickly, and the Fed has yet to commit to that pivot. So in my opinion, it is normal to see the markets are becoming a little bit more nervous until you confirm that the Fed is changing its forecast, which it has yet to do.
And the market is anticipating what kind of earnings?
Positive, and that's troubling because if you think you're going to get a significant deceleration of economic growth, you should be bracing yourself for negative profit growth. But at this point in the cycle, and the reason we did so well is that the market is saying we're going to get significant deceleration, but profits are going to remain positive on a year-over-year basis. However, Martin, we're seeing an erosion of profit margins on both sides of the border, and that will be critical with respect to the reaction functions of corporations in the face of an erosion in their profit margins, which means, Martin, what will they do on the hiring cycle? That's critical.
Mm-hmm. So employment is the key, and we're already in stagnation for full-time employment in the States.
Employment is always key in determining whether or not there's going to be a soft landing or recession. And yes, U.S. job market has surprised with its resilience in recent months, but Martin, full-time employment has been stagnating for the past few months. So already you're seeing corporations being a little bit more nervous on the hiring pace. So in Canada, we've stagnated. We've done really well over the past 2 months. But I do believe that we'll also be stagnating because we're starting to see an erosion in the profit margin. So at the end of the day, that will determine the shape of the economic cycle.
And Stéfane, what's the relationship between the stock market and recessions?
The stock market is an asymmetric in terms of leading indicator for the economy or stock market. So basically, Martin, the stock market is very good at predicting the end of a recession, but it never calls a recession. So basically, the stock market always calls a soft landing. And when they see the first rate cut, they say, hey, wait a minute, why are rates being cut? What's happening here? And then it gets a little bit more volatile. So this time around, I think the volatile could come even faster just because of the geopolitical backdrop.
Yeah, when we're actually in the first year anniversary of the war in Ukraine. So lots of uncertainty there.
And the uncertainty comes, Martin, from the fact that if there is very specific infrastructure that are destroyed in the coming weeks related to food production or energy production, you could see global inflation turn the corner and start accelerating again. So again, let's not be too greedy at this point in time. Let's play defense because we have yet to see what happens at the end of the month on the Ukraine-Russia conflict, which is still very important for a global perspective.
Excellent. So in conclusion, we're remaining prudent. We're going to see the impact of higher rates in the coming months, and we've already priced a lot in the last 2 months.
A lot of good news, yeah.
Yeah, lots of good news. So thank you very much, Stéfane. Thank you, everybody, for having been listening to us for the last couple of years. It was a pleasure to be doing this. We learned a lot in communication. And let's remember Dr. Weiss telling us in October 2020 that we would be back to normal in 2024. So it's been a great ride. Thank you for listening. And there will be more of these short videos. Do not worry. Thank you. Take care. Bye-bye.